Welcome and thank you for joining us for another ClearlySo Sector Insights discussion. This time we have David Gowenlock, who leads our Impact Funds Advisory business. He will be speaking with us about what he's seen over the last few months with regards to impact funds. So David, thank you for joining us.
Thank you, Theresa. It's nice to be here and have an opportunity to talk through what's been going on in the impact fund space recently.
Do you want to just take a minute to introduce yourself to those watching?
Certainly. So I'm based on ClearlySo's Impact Funds team, advising top-tier European alternative fund managers on structuring and raising capital for impact fund vehicles. I've been with the firm for just over a year now, and before joining ClearlySo, I worked at two London-based asset managers, one investing in climate-smart agriculture in emerging markets, the other in tech for good UK ventures.
Thanks, David. We're going to jump right in, and I'm really interested because we've talked with the other deal managers and people at ClearlySo about what has happened in their sector, but for you, you're looking at a wider sort of business around impact funds. So what has changed for impact funds during lockdown?
So firstly, coming at this from the GP side, we tend to put people into three buckets in terms of how they've been impacted by COVID. The first is those with affected portfolios. These are obviously GPs, fund managers most affected by COVID. They've in general have retreated and are focusing on portfolio management. That is either to help pivot businesses impacted by lockdowns or to manage bridge financing for those with cash flow issues. The second bucket are those who are well placed or were well placed before the crisis. And these fund managers have continued to fundraise. So although the macro picture shows fundraising is down, there is still plenty of capital being committed by LPs. And obviously those GPs who had strong relationships with potential investors pre-COVID are best positioned, as LPs have had limited ability to meet with new managers, a fact which may have helped crystallize some of the commitments being made at this time. The third bucket are managers who are looking to launch impact strategies at this time. So this has been perhaps in part fueled by all of the reporting in mainstream press. Financial Times has covered this a lot about the outperformance of listed equity ESG funds and similar sustainable investment strategies. And we're seeing more and more interest from fund managers about how they can position themselves to capture the inflows of capital to these sustainable strategies. In terms of the LPs, what was changed with limited partner investors, in general, they're focused on re-ups and deploying commitments with managers whom they have a good relationship with. And again, this is largely led by their reduced ability to meet with new managers and get to know new teams in person. They are also adapting to remote due diligence and AGMs. So in a recent Eaton Partners survey in May, the firm found that respondents anticipated a shift into the way they would evaluate future opportunities. So it seems this is going to be a long-term impact. 20% saying that their new normal would be heavily reliant on video conferences over in-person meetings with general partners. And PEI, Private Equity Investors Survey in May 2020 found similar results, and that actually in a period from March to May, double the number of LPs, so now up to 25% of LPs state they planned to attend GP AGMs via video conference going forward, and 21%, so again, quite a decent number of LPs saying they'll do more remote due diligence using video conference. And then the last change that we're seeing with LPs is an accelerated interest in growth equity. So between 2005 and 2019, growth equity capital raised almost tripled and reached a fundraising peak of 41 billion in 2019. And we've also seen dry powder soar, so there's now around 190 billion of growth equity dry powder. This is as of 3Q 2019. And just to put that in proportion, it's raised from 6.5% of all PE dry powder up to nearly 17% of all PE dry powder over the same time period. This is a trend I think that we'll see continue, and it's especially interesting for impact funds as fund managers start to launch second, third, fourth generation vehicles. This is an area we've covered in our recent Funds Quarterly, which you can subscribe to on the ClearlySo website.
That's a great plug for people to learn more about what we're doing in impact funds. I mean, in terms of your work with those GPs and LPs, what's some of the advice that you've given the most in the last few months?
Interesting question. So GPs are more commonly coming to us to ask how they should be talking about impact. The latest GIN data shows that 90% of asset managers now are using external tools. So far and above, the vast majority of GPs are using external tools. The most commonly reported being the SDGs and the GIN's IRIS. Perhaps that's no surprise that the GIN survey finds that their own methodology is most commonly used, of course, because their survey set is likely to be biased towards people who associate with the GIN. ClearlySo, we feel that the SDGs are a great tool for communication and for talking about sustainability and talking about these issues, but we don't feel they represent the most rigorous framework for impact measurement. And LPs are certainly starting to probe GPs more thoroughly on really what they are measuring, why they've chosen to measure those things, and how they are attributing additionality to their investments. We're also seeing more LPs become sensitive to negative impacts or perhaps externalities. This is as it becomes more apparent that environmental and social risks really can have a material impact on financial performance. One other topic that's come up quite recently in conversations is GP alignment in terms of impact creation. And this idea of impact carry is certainly still alive. One progressive fund manager we've been speaking to has included in their LPA a pledge that if certain impact hurdles are not met, a portion of management fees will be used to purchase the appropriate representative outcomes from external partners. So this guarantees to limited partners that the impact of that fund will be achieved either by the fund itself or by other mechanisms. And we quite like this because we feel it creates a stronger alignment than what some other GPs are doing, which is a token donation of a portion of fund fees to philanthropic projects. This is a very well-intentioned effort, but it, in essence, is sacrificing LP returns to boost impact outcomes. We really like where there's a mechanism in place that links the performance to the impact outcomes.
I really like that term, impact hurdle. I think it really nicely describes what you've said this fund manager is doing. So if we get into the headspace of the investors in your field, like the LPs that are out there, when you're talking to them, what do you think they should be excited about? What are you seeing that you think, oh, actually, that's something that's really new, or it's something that gives a bit of hope, or at least gets them excited to think about new investments?
Great question. So in regards to opportunities with alternative fund strategies, the general theme that we're seeing emerge that I think we're really excited about at ClearlySo and LP seem to be more interested in is, in general, technology solutions with accelerated adoption. So that is, what technological solutions are now is the market more open to adopting, and how can an investment thesis be strung around that? The two areas we're seeing a lot of growth in are ed tech and health tech. In ed tech, this is the concept of remote learning solutions. And an example of a transaction my colleagues recently worked on is a company, Bibliu, for their Series A. It was a 10 million raise, and this is providing an online digital library that allowed students to have access to content remotely. In the area of health tech, telehealth and remote diagnostic solutions are really in vogue. And this is an area ClearlySo has recently supported GPTQ on with their 2 million Series A. And this is providing remote on-demand GP appointments. So remote diagnostics and using various sensor technologies to provide data to healthcare providers, alongside kind of technological solutions which will impact private equity and venture capital. We also see interest in some nearby alternative strategies, in particular sustainable and green infrastructure. Two main areas here are renewables and affordable or social housing. In renewables, there is a huge need for additional capacity of renewables infrastructure to meet the EU's and in fact global decarbonisation targets as we look to decarbonise our energy grids and nearby sectors such as transport. In housing in the UK, we still have a large unmet demand for affordable housing, and several large real estate investors have recently launched substantial strategies to help meet this demand. Specifically regarding VC and PE fund strategies, we feel this is a period of change that provides strong opportunity for sector specialists. They are in general much better placed to understand how COVID will affect their industry sector than generalists, and really should therefore be able to identify and seize suitable distressed opportunities and capture value creation as COVID shapes their sector going forward.
Right. So, David, at the end of this interview I'm doing with the whole team, I'm asking everyone what they're looking forward to after the summer, because we're starting to see that some things are going to go back to normal. We might even get back to the office. What are the things that you're looking forward to related to your work?
Well, like many others, I'm sure I'd love to see things get back to normal soon. And with that, the ability to attend live and in-person events. Whilst I try to remain optimistic, I can't see that happening very soon. Obviously, the Gin Forum is one of the industry's largest events, but we have a while to wait for that one, as the next event is not until October 2021. The October 8th to 9th, so this is later this year, Impact Investing World Forum. This promises to be a strong event, and I think will perhaps be one of the industry's largest to try out a new online-only format. So it's going to be interesting to see how that goes. In terms of networking, Super Return and Super Investor are really PE staples. And it will be interesting to see how these events work with a mixed online and in-person format. I feel it will be very hard to recreate these events' excellent networking opportunities in an online format, but maybe I'll be surprised and they'll pull out some tech wizardry to recreate that online. The team here are really looking forward to hosting part 2 of the ClearlySo Impact Funds webinar series. This is in partnership with Paul Hastings and Octopus Investments. The first webinar covering the energy sector is scheduled for the 17th of September, so you can get that in your diary now. And in the meantime, I'm eagerly awaiting socially distanced catch up with colleagues once the ClearlySo office reopens in September. I'm one of the seemingly less common people who's really missed office life, the water cooler antics and the fantastic office environment with a group of passionate and talented colleagues.
As we've discussed, David, I'm in your boat. I can't wait to get back in the office and actually see everyone, from a distance, and maybe less of us every day, but definitely getting back in the office is a big priority for us. So I want to thank you, David, for what you've shared with me today. I really appreciate your views. And I think in leading our impact funds business, you really have gained a lot of insight into what LPs and GPs are thinking right now. So thank you for that.
Thank you, Theresa. It's been fun talking through this. I hope it's been useful for the listeners.
Yep, absolutely. So thanks, everyone. And as David said, the Impact Funds webinar series registration is now open. So we'll put a link at the bottom of this video. Thank you very much.
Thank you.